Ladies and gentlemen, it's good to be here. The purpose of this session is probably developed, and it's developing almost as we sit here, because as we all know, the Eurozone crisis is not only affecting every business in Europe, it's affecting businesses outside Europe and affecting individuals. I shall take Chairman's privilege to mention one or two things. First of all, I'm very pleased to see a really old friend of mine, Franz Ardhau. We've known each other for at least 20 years. 20 years when he really established a Slovene currency zone and was highly successful in doing that. And it's an interesting fact. Maybe they should, maybe the European Central Bank should listen to him. But in fact, the volatility of the Slovenian tolar throughout its lifetime was less than the volatility in the euro. That's an interesting fact. Of course, it's slowly devalued because of specific circumstances, but it's an interesting fact that the management of it was really good. To the left, I may sound impolite because I'm not taking the lady first, but these two gentlemen on the left I know. Matjaž Ganta is one of the most successful businessmen in Slovenia, managing KD Group, an investment group, and an innovator, and I've known him for how long? 3 or 4 years? 3 or 4 years now. To my right is Agnes le-thiec, who I found out is actually a Breton. She's it sounds as if she's a Belgian when you read but she's not. She's a Breton, so she's probably a Breton first, a French woman second, living in Belgium, and probably likes to think of herself as a European as well. So so she's a real continental. And if I know anything about the Bretons, they're a bit like the Welsh and the Irish in the British Isles. They're lovable, excitable, lovely, enjoyable Celtic people. So I'm sure she's all of those things. And then to the far right is the president, who you've met already, and I'm not sure I need to add too much to that. This session, as I said, is really trying to look at what the problems are, and my own view is, and I think it's written down here a little bit on the program. We've had a situation for 2 or 3 years now in the Eurozone where we've had too little too late, and probably too often, so that markets, they see a measure and markets jump by a few points, the problem is solved, and then a few days later they realize it's not solved. And then we have that again, and we have that again, and we have that again. And that totally destroys confidence in the international sphere. So when we see the latest measures that are going through, and a very important step forward by the German Constitutional Court, approving the purchase of bonds, markets automatically say, is this another one of these measures that's really not going to perform? And there's an old saying that you take 25 years to build a reputation and you can lose it in 25 minutes. So it's going to be a hard road, in my opinion. The challenge in economic terms is the Eurozone really an optimal currency area? I don't think that's been answered. Did we really have a European Central Bank, bearing in mind that it wasn't a lender of last resort? It didn't, initially anyway, make much in the way of market operations, which is a typical central bank matter. And so there must be a worry as to how it operates. And then one final thing, it seems to be an attempt to invent a totally new model. If we take the United States model, of course, the separate states could issue their own bonds and go bankrupt. So, and everyone knew that. Whereas we sort of got that model and no one knew it. So that was a problem. If we take what was the old British Empire model, the sterling area model, that was a transfer union, so that you had variable exchange rates, but fixed more or less, between Australia, New Zealand, UK, Kenya, Cyprus, wherever. So that had a flexibility. It had to go in the end, but that was another model, and the Eurozone seems to have tried to invent a new model, which we have to admit at this moment is not working. So the question that I'm prompted to, on prior discussion that we had here, was to say, will the Euro survive as we know it? That's a key question. And will it have the same membership as we have at the moment? So having said that, I'm going to ask each of the panelists to give their initial thoughts, and this time I'll be gentlemanly and ask Agnes to be first.
Thank you very much, Mr. Miles, and I'm glad to see also a British person as a moderator, because they also have lots of Celtic people in Britain, so that's going to help the friendship between our two countries. Good morning, everybody. Very glad to be here. I'm working for CFA Institute, Chartered Financial Analyst Institute. I'm going to talk more to start about the core subject of this panel, which is Eurobonds. What are Eurobonds? So Eurobonds, it's the common issuance of sovereign debt among Euro area member states. And as Mr. Miles said, the Eurozone has been in crisis for 3 years now. There is a lack of trust in the capacity of Euro member states to, some Euro member states to pay back their debt, and we have seen that through skyrocketing yields of the bonds of some sovereign debt. And so there have been several steps being taken, several measures. As Mr. Miles said, they were probably not enough or not strong enough or coming up too late, and they didn't restore trust in the capital markets. So because of this, one of the ideas being discussed now in the EU is Eurobonds. That's why they come back to on the stage. It's an old idea, it has never worked, but that's now why the discussion is coming back. So it would be, of course, the very daring and bold proposal to solve or try to solve the Eurozone debt crisis. Clearly, the advantages are that the people who are defending the Eurobonds are seeing is to lower the yield of the sovereign debt, and to create also a big Eurobond market with deep, which would be highly liquid and very deep, and which could potentially compete with the US Treasuries market. The big disadvantages of Eurobonds and why they have been attacked so much and why they didn't materialize yet is that there is the risk of moral hazard. As you know, Eurobonds are seen as a potential incentive for some member states to not implement the fiscal measures and the structural reforms that are very much needed today. Another big disadvantage of Eurobonds is that it is felt that the stronger member states of the Eurozone are going to it's the weaker member states of the Eurozone that would be benefiting from common insurance of sovereign debt, while the stronger member states like Germany, for example, would mostly end up paying for others. So this being said, the European Commission, pushed by the European Parliament, did publish a consultation on what it called stability bonds last November 2012, and they disclosed in January this year. And since us in CFA Institute, we represent investors and financial analysts, we ask our members what they were thinking about the Eurobonds, basically whether they would be buying these Eurobonds or not, and what would be needed for these stability bonds or Eurobonds to make them a success. So we had a poll among our membership in Europe, which is 15,000 members, and we shared this result with the European Commission, the Parliament, and the Council. And I'm going to just tell you a bit more about these results. The first result we had is that this chart, which you are seeing behind me. We ask our members, who again, they are portfolio manager and they are financial analysts, so they are research analysts, all kinds of financial analysts. And we ask them, what do you think would be the impact of stability bonds, i.e. common issuance of sovereign debt among euro area member states? And a slight majority, I'm saying a slight majority, said that Eurobonds would alleviate the sovereign debt crisis, that's 55%, reinforce financial stability in the euro area, 52%, and facilitate the transmission of euro area monetary policy, that's the monetary policy by the European Central Bank. However, and this is a big but, only for 41%, so that's a slight majority, believes that Eurobonds will not improve market efficiency. Why? This is, again, the risk of moral hazard, saying that if we have Eurobonds, the weaker member states are not going to implement the reforms that are needed to restructure their country and get lower yields on their debt, since they would benefit from the lower yield at the Eurozone level. Another recurring comment that we had from our members is that no financial instrument whatsoever, whether it's Eurobond or the European Financial Stability Facility or the European Stability Mechanism, which is just starting now, is going to cure the structural problems of the Eurozone. So for them to be trusting Eurobonds, you need anyway to have some structural reforms in the Eurozone. They will not. That's a fundamental analysis, and nobody will escape that. You need us to also to deal with the imbalances in competitiveness and in trade between the different member states. So we ask them also about the type of guarantees that our members, as investors, we need to see attached to Eurobonds for them to be willing to buy these Eurobonds. And there are 2/3 of them who are saying they would want to see a joint and several guarantee on these Eurobonds for them as investors, as financial analysts, to buy them or to recommend to buy them. Joint and several guarantee, that means that a member state is not only responsible for its share of the Eurobonds, but it's co-responsible with the liability of the other euro area member states participating to the stability bond issuance. 20%, 22%, 11% said that a several guarantee was sufficient, and 22% said several guarantee, so a member state responsible only for its share of the Eurobonds, but with credit enhancements that mean collateral, or that mean a type of seniority between the Eurobond debt and the national debt. The following, then the 2/3 of the members said also that for them, Eurobonds, if they happen, should not replace completely the national debt. They should be covering part of the financing needs of the member states, but not all of them. So there should remain some nationally issued debt. Then another question is that, well, we ask them, do you think that Eurobonds, if they happen, should happen overnight or should happen gradually? And there as well we had a large majority which said they should happen gradually. So this consultation by the Commission was closed in early 2012. Again, it was requested by the European Parliament. And just to show that the thinking on this common issuance of that is progressing in Europe is that in June there was a report published by the European Parliament which is talking about a roadmap towards Eurobonds. Because everybody realizes that Eurobonds are not going to happen overnight, that you cannot have Eurobonds overnight, you don't have the right governance in place, you don't have the right controls in place for this to happen. So it will take time. So they are talking about a roadmap towards Eurobonds. That's what the European Parliament is mentioning now. That's also what the Council is mentioning now. I really invite people who are interested in the subject to read the June report of the Van Rompuy, the President of the Council. He wrote it together with Draghi, the European Central Bank, Barroso, the Commission, and Juncker, so that the Eurogroup. That's really a report that is called Towards a Genuine Economy and Monetary Union, meaning that there is no genuine and monetary union at the moment. And this one also mentioned Eurobills as a potential first step towards Eurobonds. So there we polled again our members about these Eurobills, whether they would, what they would think about Eurobills. Eurobills, so it's Eurobonds with short maturity, less than 1 year. And we asked our members, what do you think about this? So first, they were thinking that Eurobills would be a pertinent first step towards Eurobonds. So we would not reach Eurobonds in the short term, but they could be a pertinent first step. So that's a big majority, 79%. Then again, a slight majority thinking that Eurobills would improve financial stability, alleviate the sovereign debt crisis, and reinforce stability. But the same but as with stability bonds, they would not improve market efficiency. So again, there is the risk of moral hazard that some member states, that this would not lead the weaker member states to implement the much needed structural reforms. In terms of impact on the yields of bonds, we have seen that with the recent news, the yields of the peripheral countries, Greece, Portugal, Ireland, also Spain and Italy, have been decreased. Here, 2/3 of our members were thinking that the yield of Eurobills would be, on average, lower than the average of the yields of the different member states. Clearly, however, they were also saying in their comments that some countries would benefit from lower yield, and here we are talking about the peripheral countries, and some countries, stronger countries, would pay an higher average bill, like Germany and the stronger country. Then we asked them, which type of guarantees would you like to see associated with Eurobills for you as investors or financial analysts to buy them? And 74% still want a joint and several guarantee, so full solidarity among the member states participating to the issuance of Eurobills to buy these bonds. They also want some conditionality, so they want some monitoring to be established at EU level, some control to be established at Eurozone level, sorry, not EU level. And they want some recommendation to be enforced to trust Eurobills. And here I fully agree again with Mr. Miles. The problem is trust. If we want investors to trust sovereign debt, they have to trust the fundamentals. And the last question we ask them is, do you think you could improve financial stability in the EU? And there, what they meant, the majority, 64% said, increase surveillance and intrusiveness by the EU in the design and implementation of national fiscal policies and draft budget. And 62% wanted a fiscal union with specific tax revenue allocated to the EU budget or backing up the common issuance of Eurozone debt, and 57% said they wanted a banking that they thought a banking union would reinforce financial stability. The banking union, which has just been, for which, as you know, a proposal has just been published last week by the European Commission. So in conclusion, they believe that Eurobonds could help, that they would have some disadvantages, but the risk of moral hazard is huge and it has to be put in control, and the right controls and monitoring have to be put in place. So this is going to be a continuing long story. Thank you.
Thank you, Agnes. And you know the British like fair play, so I think we ought to have a Slovene now and share it out between Belgium and Slovenia. So, Dr. Ardha.
Thank you very much. Good afternoon, ladies and gentlemen. Thank you to you, Kit, for the introduction and the invitation to join this meeting. Maybe a few words or some doubts vis-à-vis current presentation related to Eurobonds, from my point of view, which are, for me, key problems and key issues. Anyway, European solidarity. We know how to understand solidarity. Yes, of course, it is very interesting for any creditor, especially if you know how is showing the picture, the picture on structure of European Monetary Union, who is who in this union. And we know who is number one from economic point of view. Yes, of course, Germany, and which was influence of Germany regarding creation of European Monetary Union as well ECB. Look, to understand German approach to this issue, I suppose it's pretty easy. It's pretty easy, excuse me, from 2 points of view. Firstly, from German one. We know that as Germany took over or made amalgamation between East and West, they introduced so-called solidarity tax for future development of common Germany, 7.5%. This tax is still in force. On the other side, look, this small country of Slovenia was faced with one similar story, which was connected at the beginning of Slovenia with so-called new financing agreement, which was made with London Club, composed in this case of Yugoslavia by 240 banks, private banks. And this contract has had also solidarity clause. And our ambition was, yes, of course, in negotiations with London Club, to state how much should be a debt of Slovenia, because the total amount was by 20 billion US dollars. And we know that in favor of London Club, such clause was, first of all, a very interesting one, and was introduced in the time of crisis in which came former Yugoslavia due to foreign exchange debt. And as you know, probably after 3 years of negotiations, we succeeded to find a new solution. Thirdly, look, I was involved in our discussions at that time, before euro came on the market, in BIS. You know that BIS is central bank of central banks. And at that time, Mr. Lamfalussy was general manager of European Monetary Institute, which practically speaking started with preparation on European Central Bank. At that time, we have had very difficult discussion. Which should be preconditions for creation of euro, preconditions for monetary policy. And you know, Belgium, Italy, which was the level of public debt vis-à-vis Maastricht Treaty? Maastricht Treaty by 60%, both countries above 100%. So that this was one very difficult question. Vis-à-vis central banks was clear answer. It is impossible to start with those countries. And why I am stressing those facts? Simply because we know that international financial markets are not moral neutral, are not. Because we know, despite this fact, that it was known that two members from the beginning on are above Maastricht Treaty, was not a problem to buy the bonds. To buy the bonds, please, with, let me say, euro interest rate. Don't forget, that immediately, as was known, that for the old debt of those different countries will be the old interest rate, now in euro, but the old one from Italian lira, the old one from Greek drachma, and some other countries. Immediately as came this information on the market, have been made additional investments. Why not? Yes, of course. New currency will be euro, and for new currency related to the old debt will be the old interest rate. This was very, very difficult question. 2 years we discussed this problem, and on one side we have had one solution to introduce for the old debt new European interest rate, and in such situation it was stated that should be a huge risk that the debtors will be faced with different lawsuits. Because in nominal terms it was huge difference, because you know that as euro was introduced, the basic rate was by 4.75, and in those countries above 10%. And you know, in accordance to the old civil law, it's a very famous rule, caveat emptor. That means creditor should be without any changes and should be fulfilled obligation vis-à-vis him in accordance to nominal terms. This was one possibility, and the other one, yes, of course, that the old debt should be with the same nominal interest rates as in the past. And on this basis, we have been faced with the expectations that will be not the case, that those creditors will start with lawsuits. And yes, of course, finally decision was in favor of the old nominal interest rate, which was in those countries. This is the third issue. The next one, we know that in this period, since 1999 to May 2010, as we have been faced with Greek crisis, we know how was split de facto this debt among which countries, who was on the first place related to different derivatives, and so on. So that all in all, if we look today's situation, public debt among members of European Monetary Union by 79% of GDP approximately. And with such asymmetry in development, it is difficult, here is additional argument, which is speaking in favor of Eurobond. And vice versa, we are not faced with fiscal union. As we discussed in my time with ECB, how should we manage economic policy in different countries? Do you remember what's happened in the beginning in the case of Ireland? Yes, of course. High inflation rate, between 6 and 7, as euro came on the market. Economic growth between 8 and 9%. Due to this fact, the surplus in the budget. On the other side, European interest rate by basic one by 4.75. And due to all those facts, a huge credit growth, 60% on year basis. And credit growth destroyed two markets, capital one, as well market for real estate, not only at home in Ireland, but also partially in Portugal, especially on the south of Portugal. Yes, of course, and we are, at that time, we have spoken that Ireland should be benchmark for all other countries in similar situation. How to give support to the growth of the economy, to make faster steps in direction of higher level of living standard, and so on. I wanted to say following. It is also today pretty clear that it exists, and especially in Europe, very tight link between credit growth, banking credit growth, and development on capital market. Because also after this crisis, or now in the crisis, if we are analyzing different countries, together with Slovenia, for instance, what's happened last year, for instance, on the base of those two activities, one regarding credit supply, and on the other side, capital market. We can state, for instance, last year, Slovakia has had 8% credit growth. Czech Republic, 5%. Poland, 8 or 9%. And on the other side, also very positive movement on capital market. In our case, we haven't any credit growth. We have negative one, yes, of course, because also here was stated in 2007, as we have been faced with credit growth of 42%, Slovenian stock exchange reached the highest point in Europe. In 1 year, 78%. So that credit supply was a key engine, also here in this country, for both markets, capital one as well real estate one. And yes, of course, very high liquidity on European level. Do you remember which type of monetary policy was led in the case of ECB as well, Fed United States? Very easy, very soft monetary policy. Practically speaking, without interest rate, or with very symbolic one. Do you remember ECB made the first step in direction of higher interest rate in December 2005, from 2 to 2.25 was the basic rate. And the highest was reached in August 2008, as already inflation in Europe came on the level 4.2%, vis-à-vis Germany, a disaster, due to non-price stability, which was a benchmark for Germany after 48. So that I wanted to say that in my discussion with former chairman of ECB Dijsselbloem, in our process of preparation on monetary union, many times was stressed, fiscal policy, it's domestic one, it's very important vis-à-vis common legal tender euro. And fiscal policy should be additional guarantee that different differentials which are connected with an economy should be supported vis-à-vis legal tender by this fiscal policy. And look, current situation in Slovenia. On one side, it's known where it's European public debt, parallel also Slovenian one, by 50% of GDP. And despite this fact that here is huge difference, what is the most important? We know, all of us know, a trust, a confidence of financial markets, vis-à-vis, let me say, daily policy, and expectations based on this daily policy. If we don't believe in different measures, regulations, and so on, we have the fears. Doesn't matter what's the size of the economy. Doesn't matter, because this small country, it's nothing vis-à-vis huge Europe, etc. But we are faced today, yes, of course, with very clear answer. We don't believe to your development on this basis, in accordance to current rules, etc. So that, please, once again, I can't believe that Europe will introduce Eurobond on the basis of solidarity. Secondly, that current discussion on banking union has still a lot of very difficult questions. I participated last week in the session of European Banking Federation, and we opened many additional questions. Now, on one side, vis-à-vis 29 so-called systemic banks, vis-à-vis common supervision, and vis-à-vis, what is very important also, let me say, common guarantee regarding deposits of population, small and medium-sized companies, because we know now in the crisis time also this country, in November 2008, introduced amendments to the banking law, and we have had also in this country, please, till the end of 2010, a state guarantee for all deposits without any limitation. Which type of moral hazard was introduced in this way? I suppose everyone has one perception. And on the other side, it was introduced also a possibility to engage a state as a guarantor for the bonds issued by some banks. And in reality, 4 banks in Slovenia issued the bonds on the basis of state guarantee. So that all in all, I am optimist vis-à-vis euro, because I'm sure in following direction. It can't believe that we can have two types of euros. One for the north, one for the south. Can't survive. If one can't survive, two in addition without result. It is pretty clear, and we know what's happened before euro came on the market, that, for instance, Austria introduced fixed exchange rate vis-à-vis Deutsche Mark already in '73. That a silent cooperation was reality between Netherlands and Germany. So that Dutch legal tender was also linked to Deutsche Mark. And in the latest time, also Finland, if I'm analyzing this economy, for me, it's totally close to those 3 economies. So that if we should have the name euro or Deutsche Mark, or I don't know which name, I am sure that due to very very tight cooperation and especially very small level of asymmetry, in those cases they can survive with new currency. And on the other side, I am sure that they will make they will do all what is needed that euro will survive. Together with last activities which have been adopted by ECB, because this is the other story, which are key differences between monetary policy in the States versus euro. But anyway, also in this case, it is here additional argument in favor of market sentiment, market confidence, let me say, vis-à-vis US dollar. Thank you at the time being.
Thank you very much. And I think what we'll do is we'll ask Jean-Pierre to add his comments. Then we'll end with Matej Gantar, because he's at the market coalface. And so we've gone around the institutions, but we're ending up in the real world as the last introductory comments. Jean-Pierre.
Thank you, Mr. Chairman. In fact, after so much wisdom that I've heard from our two colleagues here, it's difficult to have a good panel with antagonism. But let me say first of all that I fully approve what our two speakers have said. It was much easier to introduce a euro than for countries to give up their sovereignty in monetary, financial, and fiscal matters. To introduce a Eurobond is perhaps also easier than to make it work for many years if we do not manage to have the necessary restructuring. Let us be very frank, many countries have been cheating with their budget figures. They have used tricks which are just scandalous. Having integrated pension funds as if of state-owned companies as if they were an income of the year. Having sold buildings with sales leaseback. Having given guarantees which are extremely high as compared to their budget without mentioning them in the Maastricht Treaty percentages to announce. So markets will decide. And the matter of the Eurobonds is more a political matter than an economic matter. There's a decision. But because we speak about policies, we should also have some interest for the social aspects. I'm not sure that these three institutions that went to Greece were necessarily the right people to convince the trade unions and to convince the poorer people in these countries that they had to reduce their minimum wages. I remember that, and it is a short story, it will not be long. I was in South Africa, and we talked about certain politicians. And it was a social worker, a certain Miriam, who told me, this politician will not convince our people because they have never had the taste of poverty in their mouth. And when very rich institutions, International Monetary Fund, European Central Bank, European Commission, with delegates who are extremely highly paid, come to Greece to say to the workers that they should reduce their income, I don't think that that was the best way to convince these people. There are absolutely ways of doing things and of convincing a population. Regarding the euro, the purchasing power parity is not in favor of the euro as compared to the United States dollar. You do with $1.30 much more than with in America than with €1 in Europe. Is it not the question that this euro is too highly valued that makes it difficult for some of our exporters? We all say that many of these countries on the periphery have difficulty in exporting products. Is it not also due to a euro that is too highly valued. Of course, politically, we are very strong. We create a banking union and everything will change because there will be the same supervision, the same rules, etc., the same rule book, the three aspects. But in fact, will that change totally this situation? We all know that the banks have made huge mistakes with the subprime period, also in overvaluing certain sovereigns. And we also know that the countries have been the victims of some of that behavior because they had to bail out these banks. So the situation is, I think, a situation whereby we have to have the political strength to insist on a better running of the financial institutions at all levels, supervisory, also banking level, and more honesty in the statistics of the budgetary information that we are all entitled to.
Thank you very much, Jean-Pierre. He's a man after my own heart because, as Jure Marjanovic said earlier, transparency is really so important for going in the right direction and getting the right decisions. If I may now turn to Matthias Gantar, as I said, he's someone who's out there at the coalface dealing with the public as investors and dealing with companies. And it's worth remembering that many countries, which Slovenia is one, there was one statistic which looked good, and that was the percentage of public debt to GDP. But of course, the corporate debt was hugely out of proportion in many countries, so that basic rules of finance that you very often don't go more than 1-to-1 debt to equity ratio in industrial companies. Very often they were 3, 4, and 5, and that put them at huge risk. So I'll pass over to Matthias for his initial comments.
Thank you, Kit. Well, I don't have much to add because a lot of things were said. But if I add anyway about this tragic Euro story, I mean, everybody loves Euro because benefits were obvious for every participant. But paying the bills, you know, if you get something and you didn't negotiate what was the price for that before, then you have to negotiate afterwards. So what's happening now in Europe? Well, negotiating. And there is a lot of ideas how to settle all these things. And a lot of bright people has really good ideas, but it reminds me on all those Yugoslavian stories that doctors have a lot of ideas, but patient will die in between. And I think that something like this happening with Euro anyway, because I mean, technically speaking, I mean, I don't know for such a phenomena as Euro. I mean, to have a currency without a state, and this is the problem in Union. How to step back in sovereignty. Because big states, I mean, okay, Slovenia, it's not a problem for Slovenia and maybe some other small countries because our sovereignty came from Yugoslavia and, okay, let's say 1.5 decades, we were completely sovereign and maybe we don't have such a big problem to talk about it, how to transfer sovereignty to the Union. But I think it's a big problem for big countries like France, Germany, and whatsoever. So we have a lot of interesting sayings which are not, I mean, I won't translate it into English right now, but one step was done, but the other should be two. And that's why I'm not very optimistic about Europe, because here should be innovating something completely new in monetary sphere that this would works. And I don't believe in it. There should be, I mean, European state should be done. Otherwise, I don't believe in it, and I'm on the side of opponents of euro. I mean, I love euro, and I would like to keep it, yeah, because our country is simply too small, and I think that dollar was very good currency, because before dollar we had dinar, which was not very good currency. I mean, de facto the currency in which we calculate our transaction was Deutsche Mark. I mean, dinar was just official currency, but de facto currency was Deutsche Mark. And but the Deutsche Mark based on German economy and with fiscus and monetary policy, the both. And euro is not. That's the problem. I mean, this debate about Eurobonds, of course, the Eurobonds should be implemented a few years ago, and not in years which are coming. So, it seems that EU is just an experiment together with euro. And it's quite obviously that the current European politicians couldn't find a solution. And it reminds me, I mean, it's quite not so long ago, I mean, it's 20 years for us. Why Yugoslavia fell apart? I mean, is what really necessary? I think not. Because if you are looking, for example, Swiss, in Switzerland living, I mean, Italians, in the manner of culture, of course. Italians, Germans, French, and some other, and a lot of immigrants. And everything is quite okay. So from that perspective, there was not a lot of reasons that Yugoslavia should fall apart. But this story, which going right now in Europe, it's quite, I mean, not the same, but similar. A lot of debate without proper actions. I think that if we are looking in fundamentals, I mean, Europe as a whole, as economy, is not so much indebted like, for example, United States. So what we are talking about. I mean, it's the same in our country. We are talking about the golden rule, that we have to stop borrowing money. Why? I mean, we are the, I think, second or third, the lowest indebted country in Europe. Why to stop? Because Dr. Archer said quite clear, and it's true. I mean, the growth is pushed by credits. So if you lower credits, everything stops. And this is the situation in Slovenia right now in entrepreneurial sector. I mean, a lot of companies which goes to bankruptcy could be saved quite easily if money drain what not happened. This is it. And I mean, I think that behavior in Slovenia for sure, and partly of course in Europe as well, is suiciding. I mean, nobody will kill us. We will kill ourselves. That's my, I mean, perception. And things should be done quite fast. And I mean, between 2008 and 12, this is 4 years, it's not fast. Because there was just few ideas came on the table about that union and other union and that resolution and some other resolution. I mean, in Yugoslavia we had reforms every 5 years and resolutions and ideas. And the spiral, I mean the spiral direction. And that's what is happening with Europe right now. Of course, these negotiations afterwards, yeah, quite obviously from some data, of course, because there are a lot of quite obvious things and different data, so a lot of theories. But anyway, it seems that the major benefiter from Euro was Germany. So, and on the other side, for example, it seems so from some analysis that the major benefiter of departing the euro should be Italy. So it's quite normal that Italians will try to monetize these benefits. I think, I don't know.
If I may say, it seems to me there are two strong themes that we are hearing at this introductory stage. I think the statistics that Agnes presented were quite interesting because they balance two things. One, there was still a lot of hope out there, and of course it's a particularly continental view, and the money these days comes from China and India and Brazil, so we don't know what they think about it. So a lot of hope, but also what I would call rescue fatigue. People are getting tired of another rescue plan that didn't work. So you've got those, that's the 45%, 55% that we saw on one of the charts there. So that's one strong theme. And the other strong theme is this idea that we've got to recover trust. And it reminded me, when Slovenia, before they declared independence, this is an interesting historic story. It struck me that if Slovenia was going to go it alone, they had to get trust in international markets. So one of the first things that we did, something that an initiative that I, with France, started, was to get a club of central banks to believe in Slovenia. Simply that, to believe in Slovenia. So there was a very good banker called Sir Andrew Crockett, who was at the International Department of the Bank of England, who eventually went to the Bank of International Settlements, and he believed in Slovenia. And he was prepared to get together the Banque de France, the Bundesbank, the Swiss Central Bank, the Bank of England, and show that there was trust behind this new country, and that was absolutely vital. So we did that before the event. It seemed to me that with the euro there was a belief they'll trust us anyway. You know, don't worry about it. We'll trust the Greeks fiddling their statistics, or the Italians doing tricky things with their budget. It'll all be okay. And I don't think that that was really built up, and now we're paying the price of that. So that's the second theme that I pick up from everyone. We have now three questions, and the first is for Jean-pierre and Agnes, and the question that we're putting is, and this has been addressed a little bit, will Eurobonds really save the euro, or are they just another debt union which is saying the Germans, you must guarantee this? And are there any other possible solutions? I think Mathias was somewhat skeptical about other solutions. So if I can pass to Agnes and Jean-Pierre to give some thoughts on that question.
Thank you. Very interesting debate, very interesting to hear what the very sensible and rational points made by other speakers here on this panel. The question on would Eurobonds save the euro? I think the answer of our members, at least, is no, certainly not by themselves. They could be part of the solution, but they will not be the solution. And there was a recurring comment made by our members, who are investors and financial analysts. They had the opportunity to comment, is Eurobonds or any kind of financial instrument will not solve the structural issues of reforms, and will not solve the structural issues of imbalances in competitiveness, not a unified labor market, etc. So the answer to this is no. It could be a tool, but it's not going to work by itself. And they were saying what is needed very much is to restore trust. I think everybody here has been saying that on this panel. There is a lack of trust at the moment. And what is needed for that is increased transparency. It cannot be that some member states have been playing with their numbers, and this cannot repeat itself. Otherwise, there are other things that are being done at the moment. There is the banking union. I think it was Mr. Palink, which was talking about the fact that banks had not been transparent at all. They had been doing lots of mistakes. It's true. It's completely true. There is a lack of trust in the financial services industry because of that. Also, there has been. I think it's. 37% of the EU GDP that has been paid in bailouts to banks in Europe. So this is directly coming out of the taxpayers' pocket. That's very problematic. These bailouts to banks have been paid by the member state. There is clearly a link between a national bank and a member state. There has been lots of cozy relationship between the banks and the national states, and this has to be cut in a way because it's not a healthy relationship. So that's what I would say.
So just adding something to these wise words, I think that Japan and Korea give me confidence. In Japan, they have a budget deficit which is by far higher than here. Mm-hmm. At a given moment, their financial system was at the brink of collapse. They have been bailed out under the condition that they would maintain their credit lines to industrial groups provided that they would restructure. And it worked. And they are now a prosperous country, like Korea is a prosperous country. Of course, politically, again, we call a lot of instruments lending, while we very well know that they are donations. The Club of Paris from time to time gathers and say, well, okay, these developing countries don't have to reimburse us. Well, anyway, they won't reimburse us. And we continue to invest in these countries for obvious commercial reasons. I think very much will depend on our way of convincing these countries to restructure and to be more in line with the necessary harmonization of their policies. And in fact, I think that in order not to throw good money after bad, that we have indeed to be reluctant to lend before we are sure that they will restructure their economy. It's much more important that their fiscal system works well than to take some money away from the poorest of their population.
I think Jean-Pierre has put his finger on something very important there, and that is that it's the economy. At the end of everything, it's the economy. If we don't get the economy straight, how are we going to pay back these debts? How are we going to develop? How are we going to employ young people? So that's, I think, a very powerful thing that needs to be taken into account. I've got another question here, which really relates almost to this trust question, and I'm inclined to say what, and I'll tell you the question, then I'll add the what after it. It says, is the reputational capital of the EU strong enough to guarantee the trust of markets on Eurobonds? And I'm inclined to say, what reputational capital? You know, where is it? Has it gone? You know, we're in a really dangerous situation. And I say that as an Englishman who's not in the Eurozone, but of course a huge part of the British economy is financial markets, and we're very concerned and want the euro to succeed one way or another. We are the major channel for capital into Europe, and so it's vital for us as well, even if we're not part of that. So that's a question which I think I'll address to France, because, you know, the question is the reputation of the EU strong enough at the moment?
Look, I suppose a reputation, for me, it's connected with trust and confidence. Those figures are known for public debt in the case of United States, in the case of Japan, Europe too, yes, of course. On the other side, it was stressed. For instance, which trust exists today vis-à-vis US dollar? Don't forget, US dollar needed, as I know, please, 60 years, roughly 60 years, that came on this level versus Great Britain found, because we know who was who in the past, for instance. On the other side, look, I am asking me, small, open economy, how to manage small, open economy in the case of freedom of capital movements. The latest case of Denmark. Denmark has also similar position from this point of view to join Euro or not, has opt-out clause as Great Britain. And we know what's happened with Denmark. As Russia came in August '98 in bankruptcy, it was a huge attack on Danish crown. Do we know that Danish crown, it's since October '98 in ERM2 mechanism, with euro, with the help of ECB. Here is, in my opinion, additional proof that if one small open economy is faced with freedom of capital movements, can't survive, because the size of transactions is so big one, and attack on the legal tender can be so huge one that it's a question how to survive. So that here is for me then the other question. If should be a case that, for instance, euro should disappear, then it's for me next question, again, to introduce on national levels different restrictions vis-à-vis capital movements. Because in my opinion, it is impossible to survive. It is very expensive, please, to lead monetary policy in such situation if you haven't any restriction, because market arbitrage vis-à-vis different exchange rates, it's made immediately. Sterilization, if has any influence, money quantity, on the movement of exchange rate on the end of the day on price stability, and I'm sure that it's pretty clear that the answer is positive one, you will spend a lot of money for sterilization. This country, Slovenia, as was introduced in 2002, 100% freedom for capital movements. Yes, of course, was faced with big influence of foreign exchange. And we know that if central bank is on the market and it's making sterilization, it's issuing new money, and new additional money quantity has a direct link to inflation and inflation rate. So that for small, open economies, in my opinion, it's very important to be in cooperation, in one link with bigger economies, with the countries which have a reputation. For instance, in Slovenian constitution, it's also Article 2, which is speaking that this country is social one and should be social one, social oriented. As Austria decided to link former Austrian shilling vis-à-vis Deutschmark, the first precondition was so-called social peace. To make very clear agreement with trade unions and so on, in accordance to the rules, the domestic costs will follow to German one. And we know that Austria, with this rate 7.05, came direct in 99 into euro. So that all in all, in my opinion, for small open economies, euro has a special value connected with the freedom of capital movements. To introduce again something in direction of different types of restrictions, this should be, in my opinion, was one disadvantage for total world, I suppose. So that, but on the end of the day, euro, it's a political issue, no doubt. Also here in Slovenia, as was introduced domestic legal tender, this was political issue. From technical point of view, and monetary policy was set by the central bank anyway. So that here it's, in my opinion, huge responsibility of all European politicians. How to continue, also vis-à-vis world competition with huge China, and on the other side, if we look huge China, that legal tender in China at the time being hasn't officially convertibility. We know that in the latest time, different also West companies issued the bonds in yuan, so-called DIM bonds, especially in Hong Kong. Caterpillar from United States, for instance. The China made a special agreement with Japan last week of last year, that a total trade will be in both currencies. That made a new agreement with South America, with Brazil, and in May with Iran, and so on. Here it's, in my opinion, are some steps which are showing that they have the ambition to have a similar legal tender and reputation which exists today, as we stated, vis-à-vis US dollar, for instance, despite the fact where it's a level of public debt. Parallel also Japan yen. If Japan has today 200% public debt of Japan GDP, to compare with 50% here in Slovenia, it's also additional proof and argument how it's understood de facto market confidence and so on. So that all in all, please, anyway, I am in favor of euro because here are many advantages. And on the other side, yes, of course, always it is needed something to earn. To expect that it will be sent as a present, forget it. And many people are thinking in this way, please. Automatically, if we are a part of the best group, we will get in this way. But this is totally wrong. Thanks.
I'm reminded, before I ask Matthias to comment on something, I'm reminded that I wrote, before the euro came here, an article for the Slovene press which talked about a Deutschmark zone. And I think Jean-Pierre mentioned that. And that was really based around the idea that countries like Austria, countries like Holland, to some extent even country like Poland, were using the Deutschmark as an anchor. So you had this support, certainly in the minds of people that were using these currencies, that behind it all there was this anchor that was the Deutschmark. And it seemed to me at that time that to build on that was the way forward. What in a way we did is we abolished the anchor, which seems an amazing thing to do. We just chucked it out and said, you can't rely on the Deutschmark anymore. And actually we're getting back to that, because we're saying that if the Eurozone is to survive, the euro is to survive in its current form, the Germans have got to step up to the table and become the anchor, and they're very reluctant to do that because of the cultural differences around Europe, some of which have resulted in false statistics and so on. So that seems to me where the real focus of the problem is. There are other examples of anchors. If you take the Caribbean, most of those currencies are anchored and freely exchangeable with US dollars. And yet we actually have a bad example where Argentina tried to anchor to the US dollar, and politicians, France pointed out that politicians make decisions that are to do with voting and not to do with economics. They actually destroyed the economy. So the anchor can work, but you know it's not even then a perfect answer. And now we'll go to Matthias and ask him what he thinks about this idea of restructuring sovereign debt, because when there's restructuring of debt and banks and investors have to take haircuts, it's a bit what Agnes was saying, the man in the street ends up paying, and the bankers and still get their big bonuses. So, Matthias, what do you think about restructuring and haircuts?
Well, when things doesn't come together, you have basically two options: bankruptcy or restructuring. So, and what to do in that case? Well, you have to see from case to case where the damage, how to. I mean, you have to choose the option where the cost or damage is lower, not bigger. Basically, this is it. So I think that from time to time some things have to go down to zero, but in most cases it's wise to think about refinancing and restructuring. So what does it mean? It means the economic subject, you have to see how much the economic subject can pay, let's say every month, every year, or whatever, for past debts. This is restructuring, more or less. And why the restructuring is better than bankruptcy? Yeah, a lot of reasons. For example, what we are looking and facing right now in Slovenia, our construction sector will disappear. And I think what is the problem about it? The problem is that the knowledge how to build will disappear. I mean, engineers and whatsoever will still be here, but maybe we do not aware in the proper manner that one knowledge is technical knowledge, let's say how to build a thing, how to put the drug together, how to put the car together or whatsoever. But the other thing is, let's say, business skills. So how to put company together, and let's say how to put big company together. It's not easy task, because if you're looking, for example, companies, or Slovenian companies, if you're talking about Slovenian companies, I don't see a lot of them who became in last 20 years from zero to hero. You know, I mean, those construction companies which bankrupt, all of them were more than 20 years old. So maybe there's one or two guys who built a construction company in last 20 years in let's say in the manner which should be in the same proportion of that company which were bankrupt right now. So where the knowledge goes, this is the question. And well, we are of course post-industrial country, so what counts? Services and knowledge. And nobody calculates what's happened with knowledge in the case of bankruptcies. That's why I think that we have to think about restructuring a lot more than we do. Because the asset of the nation today is in knowledge, not in cash or things like that, you know.
No, I certainly agree with that, and I was speaking to a friend of mine earlier how the Apple or the Mac policy is all the development and all the thinking and all the advances are made in the USA, and then the manufacturing goes off to China. So I don't know if you all remember, perhaps it's in the waste paper basket, but you remember that the Lisbon Declaration about Europe going this way. Well, it hasn't travelled very far along that way, and but what Matthias says is quite correct. Just one final question, and then we'll see what questions you have. And the final question is, what would happen if one country or two countries leave the euro? I think we know, and that was commented earlier, that if Italy left the euro, and Italy, there's quite a strong tide for that at the moment, the consequences probably for Slovenia is they would have to leave the euro. It couldn't survive against Italian competition. But as a general question, if we start with our two experts on the right, what do you think the consequences would be if one or more countries left the euro? Jean-Pierre.
Ladies first.
Thank you very much. That's a difficult question, again, very difficult. I think if a country, what I'm going to say is I'm not going to have very much wisdom and think. I think I'm going to say something very plain. Is if a country like Greece leaves the euro, Greece is 2% of European GDP. This can be managed. If a country like Italy leaves the euro, if a country like Greece leaves the euro from an economic point of view, in theory, it can be managed because it's so small. It's 2% of GDP. It would be very tough, I think, for Greek people, and that's a major issue. I think that the problem with one country leaving the euro is that then you further diminish the trust in the eurozone, and then people, starting with investors, start to think, well, if one country leaves the euro, then two countries can leave the euro, and 3 and 4, and then there is a cascading effect. That's the big danger, even if it's a small country. If a country like Italy leaves the euro, then we are in real trouble, given the size of Italy. And then, to me, that's the end of the eurozone.
Well, I first of all see that countries that were about to join the euro are now hesitating. Secondly, if one country would leave the euro, then the contagion or no contagion would depend on what would happen to the economy of such a country. And I think that nobody wishes it, and not even politically and even economically, I don't think that it is wished. So I think that great sacrifices will be done to avoid it.
Gentleman on my left.
Okay, thank you. We have one a very important experience if we speak on currency and foreign exchange rates with former Yugoslavia. Practically speaking, former Yugoslavia has had in practice more or less all foreign exchange models. How to survive with those models and to be better tomorrow vis-à-vis a total economy. And yes, of course, all of those models finished with the same results. On the other hand, I suppose many of you saw 1 week before elections in Greece one article which was prepared by the leader of a new political party in Greece. I saw this article. I went one time through this one and the second too. Here was not any word linked to this possibility that Greece should leave euro. So that for me it's a question. Who should be here, for instance, Slovenia, first one among politicians that he should put in the program that Slovenia will leave euro? I don't know if we have anyone. No. Because the experience in the past and the experience which showed that Deutschmark with stability was always, despite the fact that officially, yes, of course, we have had own legal tender, in the practice, a currency number 1. Doesn't matter who printed Deutschmark, because I am sure that in all countries it's the same approach. We believe to the stability of currency, to the universal access of this currency to different people and different countries. So that from this political point of view, I can't expect in those countries one person, as I stated, who will put in own program with the ambition that will be meet victory on the elections with such statement. And on the other hand, very practically speaking, if we look current different types of the contracts, for instance, we know derivatives have by majority as a governing law British one, as I stated in accordance to my knowledge, because I spent in one international bank and we made this business. Always was used British law, not domestic one, regarding different credit facilities, credit arrangements, yes, of course, that we say domestic one. If we have been faced with one syndicated loan and creditors from different countries, also, yes, of course, would not use domestic one. So that the practice in Great Britain, it is showing also one very interesting picture, which should be situation if a contractual partner decided that will start with own legal tender. Much easier vis-à-vis the situation if, for instance, Germany, or I don't know who, will or should adopt something else. Now. So that all in all, in my opinion, that here it's anyway a huge risk. And secondly, that I don't know who in the Europe now has today such power and such clear vision, and it's willing to take over huge risk, what should be tomorrow. Thanks.
Matthias.
Well, it's a tricky question. What will happen? You can say what will happen. I mean, if, let's say, one country will step out and this would be a miserable story, it will be very easy in that case to discipline the others because, you know. But if not, this may encourage some others, you know, to step out as well. Let's say we saw the story in former Yugoslavia. One republic went out and some other follows. And what was next? Well, in some republics start a war. In some republics they stay together. So Montenegro and Serbia stay together as Yugoslavia and whatsoever. But as I said, the biggest problem I see in EU is leadership. Because if we make some comparison with Yugoslavia, and I think it's really tragic that we do this, that we came so far, that we do this. But anyway, when the whole story started, when the leader died, when the responsibility became, you know, the group responsibility, who was responsible? Nobody was responsible. And who is responsible today in Europe? Nobody is responsible. Is Ms. Merkel responsible? No, she's not. Is Hollande? No, she's not. No, he's not. So I think that the leadership is the one of the crucial questions, how to manage the whole thing. I think that it's quite obvious that euro is very nice currency. Everybody loves it. Everybody needs it. I mean, not just Europeans as well, the foreign investors. I mean, the global market needs currency like euro, or especially euro, because behind the euro is strong economy on the end of the day. If you look on Europe as one place, and it's just the question of Europeans how to organize ourselves, you know, that these things will work. But we started it with Maastricht, and there was a carrot and a stick, but stick was broken by two big bears, and the carrot was eaten by the grease, you know, by the rabbit. The rabbit wants to get new carrot, but there's no stick. There's still no stick.
Thank you. I like that idea. Can I just say that if anyone's interested, it's worth going on the internet and getting from the New York Review of Books an article written by George Soros, and as you know, he's a very successful businessman and has watched currency markets very closely, and it's really a very interesting study, and I do recommend anyone that wants to see a bit more detail to go and read that. And I'll just read you something that he puts almost at the end of it, because I was reminded of it as colleagues were speaking, and I'll just read you this paragraph. By contrast, if Germany were to exit and leave the common currency in the hands of the debtor countries, the euro would fall and the accumulated debt would depreciate in line with the currency. Pretty straightforward stuff. Practically all the current intractable problems would dissolve. The debtor countries would regain competitiveness. Their debt would diminish in real terms, and with the ECB in their control, the threat of default would evaporate. Without Germany, the euro area would have no difficulty in carrying out the U-turn for which it would otherwise need Chancellor Merkel's consent. So, you know, it does focus, you know, the Germans, you've got to make your mind up, you know, what are you going to do? Are you going to be the anchor? Are you going to go? And actually, historically, it's worth remembering that Germany came in at a very, very favourable rate to the euro. it had gone through 10 years of hard times, absorbing 15 million people from East Germany. And so you've got a contrast. Germany is worried, am I going to have to, I really had to, and Franca mentioned the 7.5% solidarity tax. Have I now got to continue having this paying for the rest of hundreds of millions of people on the continent? I don't like to do that because I know how hard it was. And yet, Germany did very well at coming in at very low rates, and more or less the growth in Germany's trade balance is represented by the money they've lent out to other countries to buy their products. So, I mean, let's be honest about it, that is where the problem may well be. Now it's over to you. Any questions from the audience? Gentleman at the back. Could you stand up and say who you are and your question, please?
I'm now an independent strategic consultant. My question is, or rather, what is the view of the panel on why is the euro so strong? The euro entered the exchange fixed rate mechanism about 10 years ago at the rate of 118. It fell to 85 cents to the dollar. It went up to 162. It's now, it was down to 120, but it's strengthening. If really there are problems within the euro, if the Deutsche Mark, or Germany rather, is no longer the anchor, why does it continue to strengthen against the wishes, the needs of the entire economic area? And part of that question is, the answer is, of course, Mr. Bernanke's, or Saint Bernanke, as I like to call him, quantitative easing. But there must be other reasons as to the continued strength of the euro.
Can I ask Agnes first and then Franca second to answer that?
Thank you. I think it's well, it's funny because I asked exactly the same question to the global chief economist of S&P recently. And why is the euro so strong when in fact, when you look at the fundamentals on the eurozone debt crisis, you should think that it should be lowering, and it keeps going up and up now again. And his answer was basically this, and this is the second time I get these answers from big economists. I'm not an economist myself, and they were saying it's two weak economies competing against each other, the USD and the euro, and other currencies are increasing, but these two are competing against each other. And from the US side, it's really related to the quantitative easing being done by Mr. Bernanke. So that's the answer I got.
Franca.
We know, a very interesting question. How to understand market sentiment? It's one question. Because do you remember, as euro was introduced, your statement is correct, 1 versus 118. After 1 year, in September 2000, I do remember very well our discussions in Prague, as was organized IMF and World Bank meeting. At that time, euro came to the level of 0.86 of US dollar. That means very strong one. And vice versa in 2007, 1.60 of 1 US dollar for 1 euro. At the same time, 1.67 1 Swiss franc for euro. We know if we speak on the base of monetary policy, which are the elements which have the influence vis-à-vis the exchange rate. But please, in accordance to my knowledge and my opinion, that, let me say, the old monetary theory has only one part of influence. Because today, to assess market sentiment, vis-à-vis the regulation which was before introduction of free capital movements. We do remember that in the past, what was very known, so-called Plaza Agreement from New York, among 5 key central banks, but at that time we have had still different restrictions for capital movements. So that if we look on one side, interest rate policy of Fed, on the other side, public debt, on the third side, what's the result of balance of payments, what's the result of current budget deficit. Yes, of course, theoretically speaking, all those elements are very important for the movement of exchange rate, one exchange rate vis-à-vis the other one. But do we remember that now in the latest time, as we are faced with this crisis, the weakest euro was at the beginning of May 2010, as came to the Greece crisis, came pretty close to the rate 1.18, practically speaking 120. That means here, in my opinion, here are additional proofs how it's understood a commitment. What should be done? What should be done? It's not needed that should be done today, but it's needed what should be done in 1 year, tomorrow, and so on. So that from the other point of view, really, it is also known how much of the business, it's linked to fixed contracts, to different derivatives, and so on. So that also this part of business, in my opinion, has very important influence on those movements. And on the other hand, look, we know what's happened last year in Switzerland. As Swiss franc came, roughly speaking, 1-to-1 at the beginning of August. And then at the beginning of September, Swiss Central Bank decided to start with fixed exchange rate. Doesn't matter quantity of money which will be needed and which will be issued due to this fact, and which will be the costs for sterilization, because we know that which was discussion in Swiss Parliament related to such exchange rate. It is now only following that at the time being, still only interest rate policy is in the hands of the central banks. The exchange rate policy, forget it. And this is really in accordance to free capital movements, free markets. And before, as Kit opened this question and was comment also by Mr. Ganter. We know that, for instance, in Hong Kong has still own currency, despite the fact that China has own currency. Currency board, so-called currency board. And I know also this case from Argentina. I know very well a discussion which was led in BIS Bank between Greenspan and the governor from Argentina. Greenspan said, forget it, that United States will be lender of last resort for Argentina if should be a case that we will take over US dollar. I wanted to say that yes, of course, in accordance to such daily practice and such daily culture which is known for Asia, that if, for instance, Hong Kong dollar, it's linked 100% to US dollar, flexibility on labor market, it's needed 100%. And in Europe, in accordance to social market economy, which was introduced by German Erhard, in my opinion, it is impossible to believe that should be introduced, let me say, Asia model, please, at the time being. So that, look, this is my understanding, and with the other words, it is impossible to explain precisely vis-à-vis interest rate policy, exchange rate policy, in current situation as the markets are free around the world. Thanks.
Unless we've run over time, clearly shows that there was a lot to discuss and a lot to talk about. So if anyone has any burning question, perhaps I can take Janez, I think it is, isn't it? Janez's question there. And then any other burning questions you can ask the speakers when we break for lunch.
Thank you very much. Be short. I know that Slovenia is not on the agenda of this panel discussion, but my question is the present economic situation in Slovenia is not because of euro problems, but because of, according to my opinion, because of lack of strategy of Slovenia as a country, and as Matjaž said, a lack of knowledge of Slovenia, of the Slovenian people, how to run the country. What would you do if you were a top man of European Federation of 27 countries? What would you require from the Slovenian government in this situation?
Whenever I went to talk at universities and a student stood up and asked a question, very often it seemed a very simple question, but it was the most difficult one you ever received. So that's a really difficult question. I'll ask my colleagues to comment too, but clearly I think it goes back to what Matjaž Gantar said, that you really need leadership at the top, and then the leadership at the top says to Slovenia what they need to do. Because we all know that Slovenia has not made the reforms that Germany made, the so-called Hartz reforms. It hasn't carried forth through the privatization that Europe wants to see, and competitiveness and transparency and openness. So I think if you had the leadership at the top of the 27, which we haven't got, you might get some really clear messages rather than the Lisbon Declaration, which was a political declaration that reminded you of speeches made on Red Square. So perhaps my colleagues would comment. Jean-Pierre.
Well, the only thing I would like to say is that to attract foreign direct investments and to improve the modernization and adaptation of the economy, things that Christian Verbich does to attract international interest to the country is certainly one of the good measures to take.
It's a very difficult question. I would just only say that over the last 2 days, I've met with three young financial services people, CFA charter holder, who want to create a national society in Slovenia. And I found that the three of them very bright and very dynamic and very eager to do things. So my impression is that Slovenia has the right people and the capacity to move forward and is able to deal with these problems. That's what I would say.
France and Matjaž, any comments?
For domestic country, only 2 comments. In my opinion, it is known that for all countries it's the same recommendation, structural reforms, and for small open economy due to competition on international markets in addition, and vis-à-vis foreign capital investments to reduce a gap between promises and daily practice. Thank you.
Yeah, well, the first thing is for sure structural reforms, because in a certain time things have to go together. I mean, and if we see that they don't do together, we have to do this. But otherwise, I think that there's no a lot of, I mean, you can get a lot of instruction from the top. It's the same question if we're talking about the city. Which city got any directions from the let's say, boss of the state? No one. I mean, how the city will go on is the question of the mayor at the end of the day. And mayor is the one who probably maybe could get something or whatsoever from the state, and not vice versa. So, of course, the boss, let's say, of the big EU should be interested that the EU is vibrant and whatsoever economic territory. So he can encourage certain parts of the state to do more business, let's say. So if they have some obvious advantages, but all the rest is the matter of population on that area, and the question of Slovenia and our development is the question of Slovenes. I mean, I think that we can't talk about, you know, foreign investments before we won't get a clue what we want to do. I mean, I don't know. I mean, okay, more or less, I don't know for the country where domestic investors are not appreciated, but the foreign investors are appreciated. Okay, in banana republics, yes, but otherwise, no. But my impression is that domestic investors and domestic entrepreneurs in Slovenia are not appreciated. And it's quite ridiculous that we can expect that in that case foreign investors will make a line. They won't. Why to invest in Slovenia? I mean, if Slovenia is not a good environment for domestic entrepreneurs, it couldn't be proper environment for foreign investor. So we have to start to search for a solution from the start. I mean, what do we want? I mean, we know that we want good social standard and whatsoever, and it's quite normal. Everybody wants this, but we have to earn this social standard, and I think that we don't have quite clear answers how to earn our money which we need. I mean, I think we have quite obvious, a lot of competitive advantages. Let's say one of it is port copper. Not just port copper and Trieste together. I mean, what is going on? Trade goes up, and it's, I mean, in the environment of one country, which is EU, is on the end of the day. I think that there is a big opportunity in Mediterranean to compete with North ports, for example, because it's quite obvious that the way is shorter, you know, from via Suez and one of the ports in the Mediterranean to, let's say, Vienna, Ukraine, and whatsoever, that part of the world. This is, let's say, one advantage. But what we didn't need, nothing, or not enough. So we have to start with ourselves, what we want to do. And of course, yeah, it's quite normal. We don't have all that money which is needed, let's say, to fulfill opportunities. In that case, we have to look capital on foreign markets. But first of all, we have to know what we are selling, which capital we are looking for, and why. I mean, what will be returns on that capital and whatsoever. What will be the tax issue, tax treaty, and this kind of stuff. Just selling the companies, I mean, is a bad idea. And we are doing right now, we are talking about foreign investors in the manner to sell some companies. I mean, I don't like it.
Well, I think I know Jean-Pierre wants to come in there, but I'm going to stop now because I know we're 15 minutes over time. But if anyone has any direct questions, grab one of the panel here and ask them afterwards. But it's my duty to sum up, and I'll try and do that very briefly. But I'll start by telling, there's a very old saying in England about the story about the man who was in Ireland, and he spoke to a countryman and said, "Which is the way to Dublin?" And the Irishman said, "I wouldn't start from here if I was you." So, so we wouldn't like to start from where we are if we were doing this again. So we all, I think, agree that it was too experimental and too political. And I think we all agree that trust and confidence are absolutely vital. That is number one thing that has to be restored to make the euro have a chance. So that's very, very important. And I think Matthias used this word leadership. We are craving for some leadership somewhere. We don't see it. And that's what we need. And that leadership will give us a clear goal and a clear path that we can work to, and that will help re-establish trust and confidence. Thank you very much. Thank you to the colleagues.
Thank you very much. Thank you.
I think the most interesting thing about our panel session was a lot of honesty and a recognition that there was not enough honesty over the last 2 or 3 years with the problems of the Eurozone. And people are now looking to that, and they're not saying that every solution is the perfect solution. And I think that's very important, because you don't start to solve a problem unless you recognize a problem. And the honesty is saying maybe Germany is the problem, maybe Germany is too successful, maybe Germany is not acting as the most powerful person in the group as they should, and given some leadership. So I think that the transparency, the need for information was clearly coming through. And then also the fact that Europe and the euro has lost trust. People don't believe it anymore. And therefore there's a requirement to regain that trust and confidence if the euro is to survive. I think they were the main things that came from this panel.
It's by far much more political than financial. In fact, the markets would give an other value to bonds issued by a weaker country than by bonds issued by a strong country. So if the Germans would say, well, as from now, we will engage, if we have to borrow money, we will pay the average, while today they can borrow very, very cheaply. They will probably prefer to issue bonds at a cheaper rate. And then the question that was not asked during the whole session, who will subscribe to these bonds? Chinese? Japanese? British? Who? And what will be the consequence? Imagine we will have to reimburse. Also, the Germans will have to reimburse. Someone has to be reimbursed. So, in fact, it is certainly not a long-term solution, because the long-term solution must be economical.
On Eurobonds, people thought that this may be creating a debt union rather than a banking union. Let's share out the debts. Well, you know, that's great, because the debtor nations would like to share it out, wouldn't they? And the Germans are not too keen on that, or the Dutch are not, or the Finns are not too keen on that. I think there's more to go. It's not clear. It's part of the solution. It's not the whole solution. But as Matthias Gantar said, we need some real leadership. Where is it? We don't see it.
It should be a good issue for Slovenia, because at the time being it is known what's the level of interest rate for domestic bonds. And in this case, in accordance to my expectations, yes, of course, the price should be lower one. Because here it's expected that in the case of Eurobonds, the influence of German reputation should be a big one. And on this basis, yes, of course, should be created also the price.
You know, to avoid to throw good money after bad, first exercise that has to be made is to convince the Greek and perhaps other countries of the periphery, that they have to change their fiscal system, the collection system, and perhaps also that the very rich people would pay much more, but not starting by asking a reduction of the minimum wages, or to say to the Greeks, you should work 6 days a week. Well, what will that solve? And what will it do to the consumption? Don't forget that in the economy, the king of the economy is the consumer. If there's no consumption, the economy is falling down. So we have to maintain that. But we have to obtain less cheating. They have cheated with their figures. We have cheated in Belgium with our figures. The Italians have been cheating. Many have been cheating, not only the Greek. And in fact, in theory, in economic theory, you cannot have a common currency if you do not harmonize policies. It was easy to say we will have a common currency. It was more difficult to say we need to have synchronized, less sovereignty, so synchronized economic, financial, monetary, fiscal policies that we could not obtain. But we thought if we have a common currency, they will have to have common policies, but that did not work.